Hello everyone. Today we discuss about business environment and legal aspects. Market instead of upstream and downstream. The terms wholesale and retail are often used. Accordingly, the industry microenvironment consists of stakeholders groups that a firm has regular dealing with. The way these relationships develop can affect the cost, quality, and overall success of a business. So, we discuss today Porter's five forces analysis of market structure related with this chapter. You can distill down the results of pastel and microenvironment analysis to view the competitive structure of an industry using Michael Porter's five forces. Here we will find that your understanding of the microenvironment is particularly helpful. Porter's model attempts to analyze the attractiveness of an industry by considering five forces within a market. According to Porter, the likelihood of a firm's making profits in a given industry depends on five factors. Number one, barriers to entry and new entry threats. Number two, buyer's power. Number three, supplier's power. Number four, threat from substitutes. And number five, rivalry. Compared with the general environment, the industry environment has a more direct effect on this firm's strategic competitiveness and above average returns as exemplified exemplified in the strategic focuses. The intensity of industry competition and an industry's profit potential as measured by the long run return on invested capital are a function of five forces of competition. The threats posed by new entrants, the power of suppliers, the power of buyers, product substitutes, and the intensity of rivalry among competitors. Porter's five forces model of a competition expands the arena for competitive analysis. Historically, when studying the competitive environment, firms concentrate on companies with which they competed directly. However, firms must research or search more broadly to identify current and potential competitors. By identifying potential customers as well as the firms serving them, competing for the same customers, and thus being influenced by how customers value location and firm capabilities in their decisions is referred to as the market microstructures. Understanding this area is particularly important because in recent years, industry boundaries have become blurred. For example, in the electrical utilities industry, co-generators, firms that also produce power, are competing with regional utility companies. Moreover, telecommunications companies now compete with broadcasters, software manufacturers provide professional financial services, airlines sell mutual funds, and automakers sell insurance and provide financing. In addition to focusing on customers rather than specific industry boundaries, to define markets, geographic boundaries are also relevant. Research suggests that different geographic markets for the same product can have considerably different competitive conditions. The five forces model recognizes that suppliers can become a firm's competitors by integrating forward, as can buyers by integrating backward. Several firms have integrated forward in the pharmaceutical industry by acquiring distributors or wholesalers. In addition, firms choosing to enter a new market and those producing products that are adequate substitutes for existing products can become competitors of a company. Another way to think about industry market structure is that these five sets of stakeholders are competing for profits in the given industry. For instance, if a supplier to an industry is powerful, they can charge higher prices. In the industry, members cannot pass those higher costs onto their buyers in the form of higher prices. Then the industry members makes less profit. For example, if you have a jewelry store but are dependent on monopolistic like De Beers for diamonds, then De Beers actually is extracting more relative value from your industry, that is the retail jewelry business. Now, new entrants, the likelihood of new entry of a function of the extent to which barriers to entry exist. Evidence suggests that companies often find it difficult to identify new competitors. Identifying new entrants is important because they can threaten the market share of existing competitors. One reason new entrants pose such as threat is that they bring additional production capacity. Unless the demand for a good or service is increasing, additional capacity holds consumers' costs down, resulting in less revenue and lower returns for competing firms. Often, new entrants have a keen interest in gaining a large market share. As a result, new competitors may force existing firms to be more effective and efficient and to learn how to compete on new dimensions. For example, using an internet based distribution channel. The more difficult it is for other firms to enter a market, the more likely it is that existing firms can make relatively high profits. The likelihood that firms will enter an industry is a function of two factors: barriers to entry and the relations or retaliations expected from current industry participants. Entry barriers make it difficult for new firms to enter an industry and often place them at a competitive disadvantage even when they are able to enter. As such, high entry barriers increase the returns for existing firms in the industry. Now, buyer power. The stronger the power of buyers in an industry, the more likely it is that they will be able to force down prices and reduce the profits of firms that provide the product. Firms seek to maximize the return on their invested capital. Alternate, Alternatively, buyers, customers of an industry or firms want to buy products at the lowest possible price. The point at which the industry earns the lowest acceptable rate of return on its invested capital. To reduce their cost, buyers bargain for higher quality, greater levels of service, and lower prices. These outcomes are achieved by encouraging competitive battles among the industry's firms. Now, supplier power. The stronger the power of suppliers in an industry, the more difficult it is for firms within that sector to make a profit because suppliers can determine the terms and conditions on which business is conducted. Increasing prices and reducing the quality of its products are potential means used by suppliers to exert power over firms competing within an industry. If a firm is unable to recover cost increases by its suppliers through its pricing structure, its profitability is reduced by its suppliers' action. These measures the ease with which buyers can switch to another product that does the same thing, such as using aluminum cans rather than glass or plastic bottles to package a beverage. The ease of switching depends on what cost would be involved. While it may be easy to sell Coke or Pepsi in bottles or cans, transferring all your data to a new database systems and retaining stuff could be expensive, and how similar customers perceive the alternatives to be. Substitute products are goods and services from outside a given industry that perform similar or the same functions as a product that the industry produces. For example, as a sugar substitute, NutraSweet places an upper limit on sugar manufacturer prices. NutraSweet and sugar performs the same function but with different characteristics. Other product substitutes include fax machines instead of overnight deliveries, plastic containers rather than glass jars, and tea substituted for coffee. Recently, firms have introduced to the market several low alcohol fruit flavored drinks that many customers substitute for beer. For example, Smirnoff Ice was introduced with substantial advertising of a type often used for beer. Other firms have introduced lemonade with 5% alcohol and tea and lemon combinations with alcohol. These products are increasing in popularity especially among younger people, and as product substitutes have the potential to reduce overall sales of beer. In general, product substitutes present a strong threat to a farm when customers face few, if any, switching cost, and when the substitute product's price is lower or its quality and performance capabilities are equal to or greater than those of the competing product. Differentiating a product along dimensions that customers value, such as price, quality, service after the sale, and location, reduces a substitute's attractiveness. Now, rivalry. This measures the degree of competition between existing firms. The higher the degree of rivalry, the more difficult it is for existing firms to generate high profits. The most prominent factors that experience show to affect the intensity of firms' rivalries are numerous competitors, slow industry growth, high fixed cost, lack of differentiation, and high strategic stakes, and last but not the least, high exist barriers. Intense rivalries are common in industries with many companies with multiple competitors. It is a common for a few firms to believe that they can act without they can act without eliciting a response. However, evidence suggests that other firms generally are aware of competitors' action, often choosing to respond to them. At the other extreme, industries with only a few firms of equivalent size and power also tend to have strong rivalries. The large and often similar sized resources basis of these firms permit vigorous actions and responses. So that's the end of the video, my friends. If you like my blogs, please subscribe my channel. Thanks again for watching my videos.